I want to start today with a bit of a personal grievance. I was looking through my old high school transcripts the other day.
Oh boy.
Don't ask why. It was a dark moment of cleaning out the attic. And I realized something that, honestly, it made me kind of angry.
Okay.
I spent an entire semester in 11th grade, learning how to construct a wooden birdhouse.
A birdhouse. Seriously.
A birdhouse with the sanding, the varnishing, the little perch for the bird, the whole 9 yards. And looking back, it just hit me. In 12 years of public schooling, I learned about the Battle of Hastings, I learned the periodic table, I learned how to play hot cross buns on a plastic recorder.
A valuable life skill.
Invaluable. But not once in over a decade of education did anyone sit me down and explain the one thing that actually determines the quality of my adult life.
And that would be.
How to stop working for money and, make money work for me.
The great omission. The giant hole in the curriculum.
It is startling when you think about it, isn't it? We act as if investing is this niche hobby, something for guys in suspenders on Wall Street, or maybe something you only worry about if you have a trust fund.
All right, it's other people's business.
Exactly. But today's source material argues that this educational gap, this total silence on the subject of capital, is actually the root cause of the massive class divide we see in America.
It's not just a gap. Lynch would call it a chasm. We are looking at his classic book, Learn to Earn. And to your point about the birdhouse, he opens with that exact frustration.
He does.
He does. He points out that we teach kids to be good employees. We teach them to be good consumers. We teach them to be, in his words, labor, but we never, ever teach them to be owners.
And that distinction, labor versus owner, that is going to be the absolute heartbeat of this next hour.
Right.
Because what we're talking about today isn't just stock tips.
No, not at all.
Lynch is making a much bigger argument. He's saying that if you don't understand the history of capitalism, you're destined to be a victim of it.
Exactly. And for context for everyone listening, Peter Lynch isn't some academic theorist sitting in an ivory tower.
Not even close.
This is the guy who ran the Fidelity Magellan Fund from 1977 to 1990. He took it from $18 million in assets to over $14 billion?
The numbers are just staggering.
They are. He's arguably the greatest mutual fund manager of the 20th century. But he wrote Learn to Earn specifically for beginners. He wrote it for teenagers, for people who feel intimidated by the jargon and the talking heads on TV.
That's what I love about this. The mission of this deep dive is exactly what Lynch intended, which is to democratize the language of money.
To pull back the curtain.
We want to prove that the idea of a natural-born investor is a total myth. You don't need a PhD in advanced mathematics to do this.
No, you don't. In fact, Lynch argues that sometimes the math degrees actually get in the way. They overcomplicate things.
We are absolutely going to find out why. We're going to look at how the Pilgrims, yes, the Mayflower Pilgrims, were actually a failed business startup.
A venture capital deal gone wrong.
We're going to see why Sir Isaac Newton, one of the smartest human beings who ever lived, went broke in the stock market because he couldn't control his emotions. And we're going to look at why your localized knowledge, just knowing what shoes are cool at the mall, might make you smarter than a Wall Street analyst.
It really flips the script on who is qualified to invest. It's a very empowering message.
So catchphrase alert. What does this all mean? It means we need to stop being spectators in the economy and start being owners. Let's unpack this. Part one, the philosophy of ownership.
Let's do it.
Lynch starts with a very basic, but I think a very misunderstood distinction. The difference between savings and investment. Because I think a lot of people, maybe most people, think they are the same thing. You put money in a bank, that's investing, right?
Wrong. And Lynch is very, very firm on this. Putting money in a cookie jar or under your mattress or even in the low-interest savings account at the bank, that is not investing.
What is it then?
It's storage. You're just parking it.
It's just sitting there.
Actually, it's worse than just sitting there. It's rotting. It's actively decaying. Lynch brings up the concept of inflation, which is the silent killer of wealth.
Can you break that down, like with real numbers?
Sure. Let's say you have $1,000. You put it in a savings account that pays you, let's be generous, 1% interest per year. So after a year, you have $1,010. You feel good.
I made $10.
You made $10. But if inflation for that year was running at, say, 4%, that means the price of everything, gas, food, rent, went up by 4%. So the stuff that cost you $1,000 last year now costs you $1,040. Your $1,010 now buys you less than your $1,000 at a year ago. Your money is actively shrinking. You are losing purchasing power every single day you leave it in that account.
So saving is actually a losing strategy in the long run.
For wealth creation,
Yeah.
absolutely. It's essential for an emergency fund. You need that cushion, but it will not make you prosperous. Investing is different. Investing is when your money goes to work for you.
I really like the analogy he uses in the book to explain this. He calls it the link in the chain.
Yes. This is such a great way to visualize capitalism without all the, the political baggage that comes with the word.
So how does it work?
Lynch says that investors are the first link in the capitalist chain. When you buy a stock, you aren't just gambling. You're not just betting on a ticker symbol moving up and down on a screen. You are providing capital. You are providing the fuel.
Right, the seed money.
Precisely. That money goes to a company. The company uses it to build a factory, or to buy a new fleet of trucks, or to fund research and development for a new software. Because they have that capital, they can hire workers.
Creating jobs.
Creating jobs. Those workers get paychecks. They take those paychecks and they buy homes, they buy groceries, they go on vacation, which supports other businesses. It's a virtuous cycle.
So the investor is the spark plug.
Exactly.
Right.
Without that initial capital, that first link, the chain never forms. The factory doesn't get built. The jobs aren't created. So when you invest, you're not just trying to get rich. You're actually fueling the engine that creates prosperity for everyone else. You're participating.
Now, let's talk about the rich kid myth. Because I think a lot of listeners might be hearing this and thinking, okay, that all sounds great, but I don't have $50,000 lying around to start a portfolio.
This is the biggest mental block, the number one excuse. I'll start investing when I have real money.
Right. I'll wait until I get that promotion. Or I wait until I'm 40 and the mortgage is paid down.
And Lynch practically screams from the pages of the book, do not do that. The biggest, most powerful advantage in investing isn't the amount of money you have. It's the amount of time you have.
It's the math of compounding.
It's the eighth wonder of the world.
Lay the math on us. Give us that comparison from the book because it's so powerful.
Okay, so let's look at two people. Person A, we'll call her Susan, waits until she's 50 years old. She has a midlife crisis, realizes she has nothing saved for retirement, so she panics.
Yeah.
She starts putting away a massive amount, let's say $20,000 every single year until she retires at 65.
Okay, so she's really buckling down. That's a lot of money. Yeah.
A huge amount. Total, she invests $300,000 of her own money over 15 years. Now, compare to person B. Let's call him David.
Okay.
David starts at age 20, but he doesn't have much money. He's just starting out. He only invests $2,000 a year. That's less than $200 a month.
Pizza and beer money, basically.
Exactly. And he does this every year until he turns 65. So over 45 years, he invests a total of $90,000 of his own money.
So Susan, person A, puts in way more principal. More than 3 times as much.
Way more. But who do you think ends up with more money, assuming let's say, a standard 8% annual return?
It has to be David, right?
It's David, and it's not even close. Because David had 45 years for his money to compound, for his interest to earn interest, and that interest to earn more interest. He ends up with significantly more money than Susan, who tried to play catch-up for 15 years.
It's the snowball effect.
It is. The snowball needs a very long hill to roll down to get big. If you start at the bottom of the hill at age 50, you have to pack a lot of snow yourself. It's all effort. If you start at the top at age 20, you just give it a little nudge and gravity does all the work for you.
That is incredibly empowering. It means the playing field is leveled by the calendar.
Mm-hmm.
If you're young, you have an asset that Warren Buffett literally cannot buy. Time. Now, another concept that Lynch brings up to help us see the world differently is the distinction between public and private companies. He calls it seeing the invisible world.
We walk past it every single day and don't even notice. You walk down your local main street and you see the deli, barbershop, maybe a family-owned hardware store. Those are private companies. They are owned by a family or an individual.
And if I walk into that deli and say, hey, I love your pastrami, it's amazing, here's $500, I'd like to buy 1% of the business, what happens?
The owner laughs at you, or, more likely, calls the police. You can't just buy into a private business. You have to be invited. You usually have to be family. It's a closed loop of wealth.
But then you have the public companies.
The McDonald's, the Coca-Colas, the Walmarts, the Nikes. Lynch plays this fun little exercise called the alphabet game to show how surrounded we are by them.
I tried this mentally when I was reading the notes for this. It's surprisingly easy. Frighteningly easy.
It is. Lynch challenges you to just walk through your house. You wake up on sheets made by West Point Stevens. You brush your teeth with Colgate. You put on a pair of jeans from the Gap. You eat Cheerios from General Mills.
You check your iPhone from Apple,
Yeah.
get in your Ford,
Yeah.
and drive to a Starbucks owned by, well, Starbucks.
A, B, C, D, it's all there. And here's the aha moment. The truly revolutionary thing about the public company is access.
What do you mean by
In a
access?
pre-capitalist world, or even today with private companies, wealth was dynastic. It was passed down. If your uncle didn't own the factory, you were out of luck. You were labored.
You were on the outside looking in. Always.
Always. But with a public company, you don't need the right last name. You don't need to be part of the aristocracy. You just need the price of one share. You can become a partner with the owners of McDonald's for, I don't know, a couple $100 just by clicking a button on your phone.
That is a radical shift in human history.
Hmm.
It literally turns the worker into an owner.
It completely dissolves the barrier between capital and labor.
That sets us up perfectly for part 2. Because to understand why that is such a big deal, we have to look at what life was like before. And this is where the history gets really, really juicy. Lynch paints a picture of the pre-capitalist world that is just bleak.
It wasn't just bleak, it was static. It was frozen. Before markets and capitalism really took hold, most people in Europe were serfs. You worked for a master, a lord. You got zero pay.
So you were basically a slave.
You were tied to the land. You got a hut to live in, maybe a patch of dirt to grow some turnips to keep from starving, but you had no ownership. You owned nothing.
And the concept of improving your lot in life just didn't exist.
No. If your father was a serf, you were a serf. If your son was a serf, his son would be a serf. There was no career ladder. There was no upward mobility. The wealth was locked up in land owned by the royals and the church. Money didn't really circulate. You couldn't invest because there was nothing to invest in.
So the shift begins when people start trading.
Yeah.
But according to the sources, the real explosion, the big bang of the stock market, happens with the Dutch.
The Dutch were the pioneers. This is way back in 1602. The Dutch really wanted to trade with India and the East. Spices, silk, pepper, these were commodities that were worth more than their weight in gold back in Europe.
But getting them meant sailing halfway around the world.
Right. And sailing in the 1600s wasn't like taking a cruise today. It was incredibly dangerous. You had storms, you had uncharted reefs, you had scurvy, and you had pirates. If you were a single rich merchant and you paid for a whole ship yourself and it sank,
You were done. Destitute.
you lost everything. The risk was too concentrated. It was too much for one person to bear.
It was an uninvestable problem.
Exactly. No single person could afford to take that gamble. So the Dutch came up with a brilliant solution, a world-changing idea. They said, what if we split the ship?
Not literally, I hope.
Financially. They split the cost of the voyage into shares. They created the Dutch East India Company, often abbreviated as the VOC. They went to the public and said, okay, instead of one person risking everything, what if thousands of us put in just a little bit of money?
So if the ship sinks, I only lose a few guilders. It stinks, but my family isn't homeless.
Right. It's a manageable loss. But if the ship comes back laden with cloves and nutmeg,
We all get rich.
we all get rich together. This was the first multinational corporation and the birth of the stock market. It created a place, the Amsterdam Stock Exchange, where you could buy and sell these shares. It allowed regular people, well, regular merchants, not just royals, to become wealthy through global trade. It decoupled wealth from land ownership for the first time in history.
This is the first time you could own a piece of a venture without physically being on the boat.
Or even knowing how to sail.
Now, here is where it gets really interesting for our history. And this was the part of the source material that genuinely surprised me. We all know the story of the Pilgrims. Religious freedom, Plymouth Rock, the first Thanksgiving. But Lynch argues that the Mayflower voyage was actually an LBO, a leveraged buyout.
It's a fascinating angle that the history books usually just gloss over. I think we have this romanticized view of the Pilgrims as these pious heroes just hopping on a boat because they wanted to pray in peace.
And that's part of the story, for sure.
It's part of it. The religious motivation was real, but the economics of the trip were messy. Really messy.
They were broke.
They were completely and utterly broke. They didn't have the money to buy a ship. They didn't have the money for food, for tools, for supplies. So to get to America, they had to go to London, hat in hand, and pitch a group of venture capitalists.
Who were these guys?
They were a group called the Merchant Adventurers, led by a man named Thomas Weston. And let me tell you, Thomas Weston wasn't doing this for charity or for religious freedom. He was an iron-fisted capitalist. He viewed the Pilgrims as a resource extraction team. He was sending them to the New World to get him stuff he could sell.
So what was the deal? What was the contract?
The contract was brutal. Lynch details it in the book. The Pelgrims were essentially employees, or really indentured servants of the corporation. The contract stated that they had to work 6 days a week for 7 years.
7 years.
7 years. And during that time, they couldn't own anything. No private land, no private houses, every bushel of corn they grew, every beaver pelt they trapped, every piece of timber they cut, it all went into a common store. It all belonged to the company.
So they were working for free for 7 years.
They were, and all that product was destined to be shipped back to London to pay off Thomas Weston and the other investors. They were serfs to a corporation 3,000 miles away. And this setup led to a fascinating economic experiment that almost killed every single one of them.
This is the communal pot issue, right?
Right, because nobody owned anything individually. The Plymouth colony was initially run as a pure commune. Everyone worked the fields together, and all the crops went into a shared supply to be divided up equally among all the settlers.
From each according to his ability to each according to his needs.
Sounds nice in theory. In practice, it was an absolute disaster. Lynch quotes Governor William Bradford's diary explicitly on this. Bradford saw right away in the first year that the communist arrangement, as he called it, was failing.
Why? What was the problem?
Incentives, or a total lack thereof. The young men who were strong and able to work hard all day looked around. They saw that if they broke their backs in the field for 12 hours, they got the exact same ration of corn as the guy who claimed he had a sore back and stayed in his hut all day.
The classic free rider problem.
Exactly. The productive people said, why am I doing this? I'm being taken advantage of. They felt it was a great injustice. Resentment built up. So they stopped working so hard. Why should they? Productivity absolutely tanked. They were literally starving to death. They were stealing. The social fabric completely fell apart.
So Bradford had to pivot. He had to do something.
He had to pivot or they were all going to die. So he made a radical decision. He tore up the communal agreement. He violated the contract with the London investors and assigned every family their own private plot of land.
He privatized the colony.
He did. He said, whatever you grow on this plot is yours. You can eat it, you can trade it, you can save it. If you work hard and grow a lot, you and your family will eat well. If you don't, you will starve.
And what happened?
Productivity exploded. It was like flipping a switch. Suddenly, the women were out in the fields with their children. The men were working from sunup to sunset because now they got to keep the fruits of their labor. They had ownership. They grew so much food that they actually started trading their surplus with the Native Americans and eventually paid off all their debts to the merchant adventurers.
Lynch calls this the birth of American capitalism, the fundamental realization that ownership drives effort.
It is the engine. When you own it, you care about it. When you are just a cog in a machine with no stake in the outcome, you do the bare minimum required.
Moving forward in history, we get to the founding of the U.S. And even there, we have this fundamental economic clash. We have Hamilton versus Jefferson. And usually we learn about this as a political fight, but economically, it's a huge deal for the future of investors.
It's the clash of visions that define America's entire economic future. Thomas Jefferson, on one hand, wanted a nation of farmers, an agrarian republic.
Right, he hated cities.
He hated cities, he hated banks, he thought factories were centers of vice and corruption. He famously said that banks were more dangerous than standing armies.
He wanted everyone to be a yeoman farmer, living off their own land, totally independent and self-sufficient.
Right, a lovely pastoral vision. But Alexander Hamilton had a very different view. He is the father of the American financial system. He understood that for the United States to actually survive, to not get crushed by industrial powers like Britain or France, it needed industry. It needed to make things.
And to have industry, to have factories, roads, canals, you need capital.
You need liquid capital. You need banks to lend money and a stock market to raise capital. You can't build a factory with bushels of wheat. You need credit. You need investment.
So Hamilton pushes for the central bank.
He pushes for the central bank, for a national financial system, for a way to fund industry. And the great irony, which Lynch points out, is that Jefferson, the guy who hated debt and banks, died bankrupt. He was completely broke, owed money all over town, whereas the financial system Hamilton built turned the U.S. into the greatest economic superpower the world has ever seen.
It's a powerful lesson.
Right.
We need that financial infrastructure to build the modern world.
What?
But, and there was always a but, markets aren't always rational. Just because we have a system doesn't mean people don't go completely insane sometimes.
Correct. And this leads us right into part 3. Bubbles, manias, and market psychology. The dark side.
We have to talk about Isaac Newton. because this story makes me feel so much better about my own bad financial decisions.
Poor Sir Isaac. It's a humbling tale.
The man discovered gravity. He invented calculus. He figured out how the planets move. I mean, a certified top-tier genius. But the stock market absolutely took him to the cleaners.
This is the story of the South Sea Bubble. In the early 1700s, there was this absolute mania in London for the South Sea Company. This company had been granted the exclusive rights to trade with the Spanish colonies in South America.
Which, on paper, sounds incredibly lucrative.
It sounded amazing. Gold, silver, resources. The problem was Spain and England were at war half the time, so the trade almost never happened. The company wasn't actually making much money, but the story was incredible. And the stock price started skyrocketing based on pure hype.
And Newton got in on this.
He did. He got in relatively early. He bought shares, the price went up, and he sold them for a profit of about £7,000, which was an absolute fortune back then.
So he did the smart thing. He won.
Well, he won initially. He took his winnings off the table, but then he had to sit there and watch the stock keep going up and up and up. And he watched his friends, people he probably considered intellectual inferiors, getting filthy, ridiculously rich.
The FOMO, the fear of missing out, it set in.
The FOMO was overpowering. He couldn't stand it. It drove him crazy. So he jumped back in, but this time he jumped in near the very top of the bubble, and he put in almost everything he had.
Oh no, I can see where this is going.
And then inevitably, the bubble burst. Reality set in that the company had no real earnings. The stock completely collapsed. Newton lost 20,000 pounds, the equivalent of millions in today's money. He was financially ruined for a huge chunk of his life.
And he had that famous heartbreaking quote.
I can calculate the motions of heavenly bodies, but not the madness of people.
That is the takeaway. It's the core lesson. Smart people, even geniuses, can make incredibly dumb financial decisions when they get swept up and follow the herd.
Lynch uses this to teach a vital lesson. Investing requires independent thinking. It's not about IQ. It's about your stomach. It's about emotional discipline. It's about having the courage to be greedy when others are fearful and fearful when others are greedy.
And we see this in modern times, too. It wasn't just a weird thing from the 1700s. We saw it in the dot-com bubble. We saw it with crypto. But Lynch brings up a more subtle, modern example, the crucial distinction between price and value.
Yes. This is so important for people to understand. Just because a stock price is going up doesn't mean the company's doing well. And more importantly, just because the stock price is going down doesn't mean the company is failing.
He uses the example of Nike.
He does. A perfect example. There was a period where Nike had 20 straight quarters of rising earnings. The business was on fire. They were selling more shoes, opening more stores, making more money year after year. The company was succeeding brilliantly. But during that same period, the stock price dropped significantly.
That would drive a normal person crazy. You'd look at the screen every day and say, why am I losing money? The company's winning.
It does. It's frustrating. But Lynch says this is where you have to be patient. The market is manic depressive. In the short term, it's a voting machine. It runs on popularity and emotion. But in the long term, it's a weighing machine. It weighs the substance, the earnings. Eventually, the Nike stock price caught up to the business reality and it soared. But you had to endure that painful period of irrationality.
Okay, so we've got the philosophy, we've got the history, we've got the psychology. Now let's get into the nuts and bolts. Part 4. The how-to of investing. Lynch outlines 5 basic paths for what you can do with your money.
Right. Let's run through them quickly because it helps to see why he lands so firmly on stocks.
Path 1. Savings accounts.
We've pretty much covered this. It's safe, you won't lose your principal, but inflation eats you alive. It's a guaranteed way to slowly lose money, a negative real return.
Path 2. Collectibles. Things like baseball cards, antiques, art, Beanie Babies.
High risk. They're very illiquid, meaning it's hard to sell them quickly for cash. If you have a medical emergency, you can't pay the hospital with a Mickey Mantle rookie card. Plus, they can be physically destroyed or stolen. Your investment can burn up in a house fire. Lynch is not a fan of this as a primary strategy.
Path 3. Real estate. A house.
Now, Lynch likes real estate. He thinks buying a house is generally a good investment for a family. The main reason is leverage.
Can you explain leverage?
Sure. You can buy a $200,000 house with only, say, $40,000 down. That's 20%. But if the house goes up in value to $220,000, you get that full $20,000 of appreciation. Your $40,000 investment made you $20,000. That's a 50% return. It's a powerful wealth builder.
But there's a catch.
There's a catch. It has a high entry barrier. You need that down payment.
Yeah.
And houses require constant maintenance. Roofs leak, spoilers break, it's not a passive investment.
Pat 4, bonds.
Bonds are basically debt instruments. You are loaning money to the government or a corporation. In return, they promise to pay you back with interest. Historically, they are safer than stocks, but they have lower returns. They're the slow and steady option.
And finally, Pat 5, stocks.
The champion. According to Lynch, stocks are, without a doubt, the best investment for the average person for the long term. There's no entry barrier. You can buy one share for a few dollars. They're highly liquid. You can sell instantly on any weekday. And historically, over any 20-year period you look at, they have the highest returns of any major asset class.
But you have to pick the right ones, or at least have some idea if they are expensive or cheap.
Mm.
And this is where we need to get a little bit technical for a second. We need to talk about the PE ratio.
The price to earnings ratio. The investor's secret weapon.
All right, I want to double click on this because I see this term everywhere. I see it on CNBC. I see it on Yahoo Finance. Amazon is trading at 50 times earnings. Ford is at 6 times earnings. I know P stands for price and E stands for earnings. But practically speaking, what is that number actually telling me?
The simplest way to think of the PE ratio is as the payback period in years, assuming the company's profits never grow again.
Okay, walk me through that. Give me an analogy.
Okay. Let's say you decide to buy a local business, a coffee shop down the street. You buy the whole business for $100,000. That is the price you paid.
Got it.
Now, after paying the baristas, the rent, and for the coffee beans, that little shop clears $10,000 in pure profit at the end of the year. That is the E, the earnings.
So $100,000 price, $10,000 earnings.
Right. So you do the math. Price divided by earnings. $100,000 divided by $10,000 gives you 10. The PE ratio is 10.
So what does that 10 mean?
It means if the shop's earnings stay flat at $10,000 a year forever, it will take you 10 years to earn your purchase price back.
That makes perfect sense. So if I see a stock with a PE of 50,
you are paying $50 for every $1 of that company's current profit. It would take you 50 years to make your money back if the company doesn't grow.
that sounds like a terrible deal. Why would anyone in their right mind do that?
Because they are betting on massive growth. They're not buying the company as it is today. They are betting that the $1 of profit today will be $2 next year and $5 the year after that and $20 in 5 years.
Ah, I see. It's a bet on the future.
It's a huge bet on the future. And that's the trap Lynch warns about. When you buy these high PE stocks, the hot tech companies, the exciting story stocks, you are pricing in perfection. You are betting that the Honda Civic is going to magically turn into a Ferrari.
And if it doesn't?
If it doesn't, if that company has one bad quarter, if the growth slows down even a little bit, the stock gets absolutely crushed. The multiple compresses. The stock might fall 50% or 70% just to get back to a normal valuation.
So Lynch prefers the opposite.
He loves the low PE stocks, the stalwarts, the boring companies. If a company is trading at a PE of 8 or 10, the market basically expects it to do nothing. The expectations are so low that any little piece of good news can send the stock popping higher.
So using his analogy from the book, buying a stock with a PE of 40 is like paying $200,000 for a Honda Civic because you think it might be able to fly one day. Buying a stock with a PE of 8 is like buying a Lamborghini for $20,000 because it currently has a flat tire.
That's a perfect way to put it. You want to buy value, fix the flat tire.
So we look at the PE. What else? Lynch have this 15 minutes a day rule for research. You don't need to spend all day chained to a Bloomberg terminal. What are the key things we're looking for?
He boils it down to 3 main things for a beginner. First, debt. You have to check the balance sheet. Does the company owe too much money? Debt is what kills companies in a recession. If they have a mountain of debt and their sales slow down, they can't make their payments and they go bankrupt.
A company with no debt can survive almost anything.
They can hibernate through a nuclear winter. A company with a lot of debt can go broke during a mild cold.
Okay, so check the debt. Second,
Dividends. Does the company pay you a share of its profits? And more importantly, have they raised that dividend consistently over time? A company that raises its dividend every single year for 20 years is a company that is very confident in its future. It's a sign of a healthy, stable business.
it's proof of cash.
Exactly. You can fake earnings on a spreadsheet. You can't fake the cold, hard cash you send to shareholders in the mail.
And the third thing to check.
Earnings growth. It sounds simple, but you have to check it. Is the company actually making more money this year than it did last year? Ultimately, stock prices follow earnings. If the earnings aren't growing over the long term, the stock price won't either.
This brings us perfectly to part 5, strategy. And this is probably Lynch's most famous piece of advice. The slogan everyone knows, buy what you know.
It's his golden rule. It's
Right.
brilliant in its simplicity, but we have to be careful with it because it is so often misunderstood.
Right. Lynch's core idea is stop listening to Wall Street analysts in their high-rise towers in New York. Look around you. You are the consumer. You have an edge.
He gives the famous example of Legs pantyhose.
Tell that story. It's a classic.
So back in the 1970s, Lynch's wife Carolyn came home from the grocery store and told him about this new product, pantyhose that were sold in a little plastic egg right at the checkout counter. They were cheap, they were convenient, and she and all her friends loved them.
Lynch presumably did not wear pantyhose.
No. But the mostly male Wall Street analysts didn't wear them either, and they sure as heck didn't do the family grocery shopping. They completely missed it. It was flying off the shelves, but it wasn't on their radar.
But Lynch listened to his wife.
He listened. He looked into the company, Hanes Brands, saw the financials were good, the PE was reasonable, and he bought the stock. It was a multi-bagger, meaning it went up many, many times over.
He also talks about Dunkin' Donuts.
Same thing. He was based in Boston. He noticed the coffee was really good and the stores were always packed. But, and this is the huge giant caveat, he didn't just buy the stock because he liked the donuts.
This is where people mess up. They think, hey, I like playing this video game, so I'll buy the stock. Or my kids love this toy, I'll buy the stock.
Exactly. That is incredibly dangerous. Buy what you know is the start of the research, not the end of it. You notice the crowded store, you notice your kids are obsessed with a new product. That is your lead. That's your tip.
Then you have to do the homework.
Then you go home and you do your 15 minutes of homework. You check the PE ratio, you check the debt, you check the earnings growth. If the store is crowded, but the company is drowning in debt and losing money, you do not buy it.
So your daily life is a source of investment ideas that Wall Street often ignores.
Exactly. The analyst sees the quarterly earnings numbers 3 months after the fact. You see the line out the door of the new restaurant today. Lynch says that is your edge. The next time you go to the mall or the grocery store, just look at what's in people's shopping carts. Look at what brands are popular. That is legitimate, valuable investment research.
I love that. It validates our own experiences. But there are pitfalls. What are the big don'ts? The things Lynch says will absolutely kill your returns.
The biggest one, the cardinal sin, is timing the market. Lynch is adamant about this, trying to predict, oh, the market feels high, I think it will crash next week, so I'll sell everything now and buy back in lower. It is impossible.
But everyone tries to do it. I'll just wait for the next dip to invest.
And they usually miss the boat entirely. The data on this is shocking. If you had stayed fully invested in the S&P 500 for a 20-year period, you would have made a very decent return. But if you tried to trade in and out, and in the process you missed just the 10 best days in that entire 20-year period, your returns get cut in half.
Half. Just by missing 10 days out of thousands.
Yes, because the biggest up days often happen right after the biggest down days. If you panic and sell during the drop, you are guaranteed to miss the rebound. You have to be in it to win it. Time in the market is what matters, not timing the market.
Okay, what about tip picking?
A terrible idea. Don't buy a stock because your uncle heard a rumor at the golf course or because your cab driver told you about a hot new company. That's not investing, that's gambling. Lynch has a simple rule. If you can't explain why you own a stock to a 10-year-old in 2 minutes, you shouldn't own it. And my uncle said so is not a valid investment thesis.
And the last big mistake, panic selling.
This is the #1 wealth destroyer. When the market drops, and it will drop, corrections of 10–20% are a normal, healthy part of the cycle. Your gut instinct is to flee, to sell everything to stop the pain. Lynch says that is how you lock in your losses permanently.
He used the Johnson & Johnson example from the 80s, right?
Yeah. Yes. There was a healthcare scare, I think, related to a potential policy change in Washington. The entire health sector got hammered. Johnson & Johnson's stock dropped significantly, along with everything else.
But the company itself was fine.
The business hadn't changed at all. They were still selling baby powder and Band-Aids and Tylenol all over the world. The business was fine. The market sentiment had soured.
So what happened?
If you sold in a panic, you lost a bunch of money. If you held on, or better yet, if you recognized it was a sale and bought more because the PE ratio had suddenly dropped, you made a fortune when it inevitably bounced back. It's about separating the temporary wiggles of the stock price from the long-term reality of the business.
Before we wrap up, we need to touch on one legal concept that Lynch thinks is crucial for this whole system to work: limited liability. Why does this matter so much to the average investor?
It sounds like a boring legal term, but it's the safety net that makes the entire public stock market possible. Imagine if you bought one share of Ford, and then Ford got sued for $1 billion because of a faulty brake system. Without limited liability, the lawyers could come after you personally.
They could take my house, my savings.
They could take your house, your car, everything you own to help pay Ford's debt because you are technically an owner of the company.
That would be terrifying.
Yeah.
Nobody would ever buy a stock. The risk would be infinite.
Exactly, nobody would invest. Limited liability is the legal principle that means you can only lose the amount of money you put in. If you invest $100 in a stock, the absolute most you can ever lose is that $100. You are not liable for the company's debts. This simple legal tweak is what encourages risk-taking and innovation. It caps the downside so you can chase the upside.
So let's bring this all home. We've covered a lot of ground today. We've gone from birdhouses to pilgrims to PE ratios. I want to zoom out to the outro. What is the big picture here? What's the ultimate message of learn to own?
I think the big picture is that capitalism, for all its flaws and its crunches and its bubbles, is fundamentally a system of cooperation. It's a mechanism that connects people who have a little extra money, investors, with people who have great ideas, entrepreneurs.
It's not just about getting ahead or beating the other guy.
No. At its best, it's about solving human problems. Investing is what funds the companies that invent the reaper to harvest wheat more efficiently, or the steam engine, or the iPhone, or the life-saving drug. When you invest, you are participating in the growth of civilization. You are helping to build the world that you and your children will live in.
I think that's a beautiful way to frame it. Investing isn't just about greed. It's about participation. It's about being a stakeholder in the future.
It is. It's about owning a piece of progress.
So here is the final provocative thought for you, our listener, to take away from this deep dive. Lynch points out a profound paradox in our education system and our society. We spend years in school debating politics and government. We memorize the names of presidents and the dates of wars and the details of laws.
We can talk about it for hours.
Right. But we rarely, if ever, seriously discuss the companies that employ us, feed us, clothe us, and entertain us. We rely on them for everything in our modern lives, yet we often treat them as if they're invisible.
Or as if they're the enemy.
Exactly. And here is the simple reality Lynch leaves us with. If you are not an owner of these companies, you are merely a consumer of them. You are on the spending side of the equation. You are paying them, but they aren't paying you back. The question is, which side of that transaction do you want to be on for the next 20, 30, or 40 years?
Do you want to just buy the products, or do you want to own the machine that makes them?
Be an owner. That's it for this deep dive. Go out there, look at the world with investor eyes, and we'll catch you on the next one.
Happy investing.